Many times we've been asked, how do you guys personally save for retirement? So we're gonna answer that in this video. We're gonna explain what we don't do, which is the conventional wisdom, why we don't, and what we're doing instead.
So Corey, you are not only an investment advisor, but an accredited tax advisor. So you know kind of all the investment options and the taxes involved in those.
That's right.
So walk our viewers through how we are saving for retirement.
Well, I'll tell you how we are not saving for retirement, Amber, and that is the traditional way of a tax-deferred 401k, IRA, or TSP.
Now this is, of course, because we own our own business. We're self-employed, and so we don't have employer contributions to things like 401ks.
That's true. But the bigger reason is the tax. In an earlier video, we actually discussed how to know whether you should save in a traditional or a Roth 401k, IRA, or TSP. So if you have not subscribed to our channel, be sure to click on the subscription button so you get these important updates. But in that video, what it really came down to, Amber, was tax rates and future tax rates in particular. Now, we've had a discussion many times. Where do we think tax rates are going to be in the future?
We think tax rates are going up.
And why?
Well, there are lots of reasons, but one of the main is because of the burgeoning national debt and also the tax cuts that we know will expire in 2026, if not before, with the changes that might be coming with the presidential race. That's
right. We're a couple weeks out from that, so who knows? But as it is right now, we believe tax rates are going to be higher in the future. So we are currently not saving in tax-deferred accounts. But there's also another reason. Our current tax situation is this. We are married with 3 children, right?
Yes.
2 of them are still minors, which means that every April 15th, when I do our taxes, we sit down, we calculate out what we owe the IRS, and then we subtract $4,000 off of our tax bill because we have 2 minor children, and that's a $4,000 tax credit. So we don't really need a tax deduction right now. Right now, if we were to invest in a traditional 401k or IRA, for example, then we get a tax deduction for that. We are already getting a great tax break with the kids. So in the future, as the kids get older and we lose that tax break, we might consider doing tax-deferred savings, but that'll be in the future.
Okay, so not the tax-deferred. We are looking at tax-free.
Tax-free, all right, okay. And taxable.
And taxable.
So let's talk about tax-free first.
Okay.
2 ways we're saving it. First one is Roth IRA. In 2020, we will contribute the maximum to each of our Roth IRAs or
$12,000.
That's right, total, combined, $6,000 each. Now, beyond that, we're also using kind of another little tax-free tip, and that is real estate.
Yes.
Okay, now I have to explain this one to our viewers. If you live in your primary residence for 2 of the previous 5 years, as a married couple, we can exclude $500,000 of gain. Now, if you're a single individual, it's $250,000. But that's not of the selling price. That's of actual gain, profit in your property. So our plan is we're going to live in our current home until the kids are done with school. We'll sell our home for a tax-free gain. And then we will move into another home for at least 2 out of 5 years and do the same thing again.
So investing in our current home and making improvements will actually be a tax-free way for us to be investing.
That's right. So we've got the tax-free Roth IRA, and then we have the real estate. And everything else beyond that is simply going into a taxable account. So we're either paying tax at, if it's an interest-bearing account, like a savings for our emergency fund that we refer to in our master class. If you haven't watched the master class, you can click on the link below and we'll talk about that. But that's the taxable interest. Otherwise, it's going in just a brokerage account with capital gains tax rate. And that's huge because right now, capital gains tax rates are at 15%, which is lower than our income tax rate.
So when we're talking about saving in a taxable account, most people think of just a bank account, which is, most banks are not paying very much interest right now. So talk a little bit about how we found the right fit for us.
Well, we used to use My Savings Direct. They used to pay about 2.5% on our savings, which was pretty good. That's gone down to about 0.5 point. I actually had a client tell me about HM Bradley, and they're going to pay us up to 3% depending on what percentage of our income we save each month. So there, right there, for your emergency fund that we talk about in the master class, that's a great place to earn just 3% interest.
Now there are some hoops that you have to jump through to get the 3%. It's not like a traditional savings account where you earn whatever interest rate the bank is giving.
Right, there's some strings attached to it, and I encourage you to check that out. But with our brokerage account, that is just a traditional joint brokerage account. Two, husband and wife on the brokerage account. We have access to it. We just buy stocks or ETFs in that account. When we sell them for a gain, that's when we realize that 15% capital gains tax.
Which is, of course, as you pointed out, less than our income tax rate.
Right, so we are using the tax law to save for retirement. We're just not doing it in the traditional tax deferred way that is kind of the default answer for a lot of people.
So if you like our tax tips and you'd like to get more tax and retirement advice, don't forget to subscribe to our channel.
Because you can make the rest of your life the best of your life.
Plan now to retire happy.